Welcome to the Biden tax hike. I'm Jim Cunningham. This is Chris Mann, who's joined us here today. We're going to be talking about all things tax increases. Chris is the head of the Munn firm, which is Mann, Urrutia, and Nelson, headquartered in the Capital Region in California. He's also my own personal CPA, so he does a great job. And Chris, we've done these a couple of times, and now I think a lot has happened since we did our last one, I think in December of 2020. Now we're in February of 2021, and we're starting to see, now that Biden's sworn in, we're starting to see these tax changes kind of hit the news. Any thoughts on that, Chris?
Yeah, I think thanks for having me, Jim. I think when we did this back in December, we didn't know what was going to happen with the Senate, and now we know. And basically there's the one party controls everything now, and so we know that a lot of these things are probably going to happen. The question is when. And so what I've been reading is it's very rare that they retroactive a lot of stuff back to 2021. They could do some stuff in the middle of the year that would be effective then, especially in charitable giving and things like that. But realistically, I expect by the time these guys get through all this stuff and figure out a proposal and a new tax act, it probably won't take place till 1/1 of 22, at least most of it anyway. They might try to slip a few things in for 2021, but it'll be very surprising to me that they do anything that's retroactive to 1/1 of 21.
So
At this point in time.
we're coming up on mid-February. That means people have a very limited amount of time to do a lot of stuff, and we're going to cover that in today's video here. Disclaimer: I'm a lawyer. Chris is a CPA. This is not advice. This is not counseling. This is not legal advice. It's not accounting advice. It's not tax advice. This is just information only. And when you're watching this, if you're watching this on YouTube, by the way, if you are watching on YouTube, subscribe to our YouTube channel. And if you're watching this months later, this stuff could all be different. So please take this with a grain of salt. So these are the lawyers at our firm, Cunningham Legal. And Chris, you've got how many? You've said 75 employees or so in
Yeah.
And I will say that, we're kind of mid-sized firms. We were talking before we got started. It's very important. A lot of this stuff is so complex. It's really hard for the solo practitioner, whether they're an attorney or a CPA, to keep up with all this stuff. It's hard enough just to get the work done. And it's not to disparage solo practitioners at all. It's just really hard to keep up with all the new stuff that's come out. So again, subscribe to our YouTube page. That keeps you, that pops up in your YouTube feed, so that you can see this important information in it, and it will prompt you to watch it. And really, this is good stuff. So how does our firm help? Most people want to pay the least tax possible while securing a legacy for their family. We're here to help you craft a plan, give you options, make recommendations that are part of an integrated plan to reduce your overall tax bill, leading to more wealth for yourself, your family, and your loved ones. Please visit our YouTube page, our website at CunninghamLegal.com. That's the URL, which is tax planning. So if you go to CunninghamLegal.com, there's a banner that you can click and it'll take you to this landing page. But these are some things to really start thinking about in 2021. And we are just finishing up with Prop 19, which is a total disaster for property owners in California. I mean, this is really terrible. And that has been a flood of work. Every lawyer is busy. I anticipate, Chris, that going forward, lawyers are going to be busy. Accountants are going to be busy, so it's important to get your team together. So the Munn firm, it's exactly the same thing, right? I know because I'm a client, right? Because I want to pay the least tax and I want to secure a legacy. So we're on the same team. So we have a new president. We're anticipating a tax hike. Why do I say a tax hike? Because that's what he said. I'm going to raise taxes. It's important to take people at their word. This is a no politics zone. This is not a political webinar. We're just talking about what candidate Joe Biden said while he was campaigning and what he and his cabinet members are now saying, to give you thoughts on what's ahead. And the idea is to minimize surprises. The last thing you want to do is show up to your CPA, April 15th of next year and be like, I owe what? Like, what? I mean, should people do planning in advance, Chris? What are your thoughts on that?
Oh yeah, always. And especially now. I mean, it's such an important time with all that the government has put on us as professionals to take care of things, not only the normal stuff that we're used to doing for 30 years with the tax laws, dealing with the tax laws, but now we've got a whole different thing with the CARES Acts, both the first one and the second one, and now a third one probably coming down the pike. So they put a lot on us to administer this with clients and get them to understand and then be educated on how to handle some of these things. So it's a whole nother level of work that needs to be done besides the normal traditional tax work that needs to be done on an annual basis.
Yeah, super important. I know I meet with you a couple of times a year. I would recommend that anybody, certainly in business, that and even retired people, because a lot of our clients are retired, but you have those RMDs, right? Those are big RMDs, and how do you deal with that tax bill? And it pushes you up into higher brackets and has all sorts of other issues going on. I'm going to spin it very briefly. We will get to taxes, but I want to put this in context. Janet Yellen is the former Fed chairwoman. She ran the Fed. She's now our Treasury Secretary. And this is really, really important because I think she's coming to Treasury with a monetary policy brain. And I'm going to give you a concrete example of that. So monetary policy versus fiscal policy. Monetary policy is about interest rates, supply of money in circulation. That's the purview of the Federal Reserve. So the Federal Reserve says we're going to raise interest rates, we're going to lower interest rates. We're going to put more money out into circulation, or we're going to take it out of circulation. The fiscal policy is taxation and government spending, and that Congress decides that. So that, we're talking now about a $1.9 trillion stimulus bill. That is congressional, that's spending. So monetary policy and fiscal policy have great influence over the US economy, businesses, and consumers. And here's something you really do need to pay attention to. And I've said this in previous webinars, modern monetary theory, you really need to pay attention to this, folks, because we are not, some of you are going to bemoan this. We are not on the gold standard. Okay. We are in an era where the United States can spend as much money as it wants without raising taxes or increasing borrowing. This is modern monetary theory. And the US gets its money from the Fed. They say, you know what? And they do some paperwork. The Fed runs a few keystrokes. Here's some more money. Once inflation starts ticking up, and Chris, we were talking about this before, we're already seeing it with oil. And oil's a leading economic indicator in terms of if oil's up, that means we have future economic activity. Well, once inflation starts ticking up, the government, using taxation, not as a fiscal policy, but monetary policy, they can pull some of that money out of circulation and take the froth out of the economy. And that is why I think, and I believe, that we're going to have a tax hike, because this is part of Janet Yellen's strategy as the Fed chairwoman, using monetary policy much more aggressively. So we're not on the gold standard. So these are some takeaways. And before we start talking about taxes, I want you to understand we are not on the gold standard anymore. The government can print as much money as it wants. The US will spend, gobs is an understatement. I don't know what the legal, the accounting term is. Is gobs an accounting term, Chris?
Is $1.9 trillion gobs?
I can't even, that's a lot of zeros. I don't know. They're going to spend a ton of money in 2021. Inflation, guys, will go upwards. It's going to happen. The feds, the federal government will increase taxes. Now it's a targeted tax increase. If you have a higher income, if you're over 400,000, capital gains taxes, if you have more than $1 million in capital gain. And if you have more wealth, over 3.5 million, expect to pay more taxes. So if you fit any one of those categories, really pay attention to what we're talking about here. And you need to start now. You need to get your team together, because here's a clear example of government spending. It's the employee retention tax credit. And Chris, I want you to walk people through. This is a massive, I don't want to say giveaway, but it kind of is. Chris, talk about the employee retention tax.
I mean, it really is a giveaway, and it's really targeted to business owners, and it's really for business owners to keep and retain their employees and continue to pay them, even though maybe their business has been down or been partially shut down or even fully shut down, to keep their people on instead of going and filing unemployment. Basically, for 2020, you've got to be able to show that you were down more than 50% in any quarter from your same quarter 2019, and then you're eligible potentially for up to a $5,000 per employee tax credit for the whole year. So it's $5,000 per employee for 2020. So it's a pretty good deal when you look at that for 2020. And you do this on your payroll tax returns. You have to go back and amend them and get it back through your 941s. So it can be pretty lucrative. You have to be mindful of, when you got PPP money, you can't use the same money for both credits. So you have to kind of work that. And when you're putting your PPP forgiveness application together, that's where you have to be really good about making sure you're utilizing the right expenses so you maximize this credit, because they kind of go hand in hand, even though they're different things. So it's really important to really have somebody look over your PPP forgiveness application and make sure you're utilizing the other, because with PPP, you only need to use 60% for employee costs. The other 40% could be for overhead costs. So you want to try to make sure you use all that 40%, so you save a lot of the payroll for this credit in 2020. Now the 2021 credit is way off the charts better. I mean, it's amazing how much better
And
this
that's the one
is.
we're looking at right here. This is
Yeah,
the 21.
unbelievable. When you look at this, I think Congress is going to wake up one day and realize, what did we do when we gave this one out, really, at the end of the day? Because in 2021, for the first 2 quarters, it changes. And so, and for the better for the employer. And so what happens is, instead of it being your income down 50%, you only got to be down 20% from 2019. So they lowered the bar, so you don't have to jump over such a big bar to be down so much. And instead of the credit being $5,000 per employee for the year, it's now $7,000 per employee each quarter. So with the first 2 quarters of 2021, you could have $14,000, up to $14,000 credit per employee. So let's say if you're paying an employee like $10,000 a quarter, you're really only paying them $3,000, because you're going to get $7,000 back from the government for this thing. So it's worthwhile. I was just with somebody yesterday talking about this, and saying it's worthwhile to bring your people back, because you're only paying them 30%. And if you qualify for this.
Now, you can game the system too, right? Like if you can delay invoicing, if you're on a cash basis, can you theoretically game the system? I mean, I'm not.
Well, there's going to be some of that. I don't know. I mean, you don't want to go. I mean, to me, it's like your whole goal in life, and you have business owners, to make money and to try to, earn, and to be profitable. And so it's one of those things where I suppose that's going to be out there, and it'll probably happen. But I think it's one of those things where you just want to, run the business the best you can. But I think a lot of people are going to be down anyway from this. So 19 was such a good year for a lot of people. In 2021, a lot of people are still struggling to get themselves back up and running and going. And so I think it's going to be easy to hit that 20%. Because the other thing is, if you could use the 2021 first quarter or the second quarter. The first quarter is better, because when you have one quarter, you get the second one for free, basically. So your best bet is to be down more than 20% in the fourth quarter of 2020 versus the fourth quarter of 2019, or the first quarter of 2021 versus the first quarter of 2019. Because if you're down in each of those 2 quarters, then you get the first and second quarter, and you get to count those as basically allowed for this retention credit. So you get that in there.
So for our clients who maybe own hotels or restaurants or fitness facilities, movie theaters, that sort of thing, that have really gotten hurt really, really hard, is the idea then to bring these people back and have them work in the business, even though there might not be much to do?
Yeah, that it is there. That's there. And they're figuring that people are starting to bring people back now, because a lot of places that have been shut down are now at least partially back. And so they're saying, hey, if you bring your people back, maybe you can have them do, like, I've had some clients bring people back that not to do the work to make money for the company, but they've come back to fix things or work around the shop or do some repair work to equipment, things like that. And that's worked out, fairly well for some people. It really, what you're banking on is you're starting to gradually come back. And I think that's why they did this credit for 2021 and made it so lucrative, is to get people back in the workforce and give the employer a break on it. And then hopefully by we get to the summertime, things are starting to get back to normal with the vaccine and everything else going on. And I could see this credit being actually extended to the end of the year, perhaps in any new legislation too, or even with a new, a new stimulus bill. I don't know if it's in the 1.9. I can't find that it's there. I haven't found that it's not there, but there's nothing that says that this gets extended. But I could see it getting extended to the end of the year. But it's so lucrative that maybe it won't. But it's time to take advantage of it for the first 2 quarters, especially if you're in a situation where you are one of those, you fit into that boat where you're 20% down over your 2019 year. And that's what they use. They don't use your 2020. I guess you can, but most people aren't going to. The 2020 was such a terrible year for a lot of people. You go back to 19 and you probably make it work better to be 20% down. And, of course, there can be situations where people are going to figure out ways to make that work. But realistically, it should be for everybody that's down. And it's not going to be that hard to determine whether you were down in the fourth quarter of 2020 or the first quarter of 2021 versus those same quarters in 19.
Wow. And this is so, and here's an example. An employer has 10 employees making 40,000 a year, which is 10,000 a quarter. Gross receipts are down by 20% in 2021 compared to 2019. Poof, $70,000 per quarter tax credit. Now it's important to understand there's a deduction and there's a credit. A deduction means that you reduce your taxable income. So you're getting, 28% or 37% break or whatever the number is. A tax credit is if you owe the IRS $100,000, you owe the government $100,000, and now a $70,000 credit, it means instead of owing 100, you owe 30. So a tax credit is the best thing to get. Far better than a deduction. We have
and you're right, Jim, you're exactly right. But one of the things to think about is this does not go on your tax returns. It doesn't go on your corporate return or individual return. It has to be done through your payroll tax returns. So what you have to do is for 2020, and actually go back to for the 2021 credit, for people that know for sure that they're going to be down 20%, that they're not even a question about it. There's a form you fill out to get an advance for this. So you can get it ahead of time, the money back now. And there's a form, and I went on a webinar about a week ago, and some other practitioners were on it, and they said they've already done this, and the money came back within 2 weeks. It was quick. So if somebody's in a situation where like, hey, we need cash flow, we got some issues going on, and we're waiting on PPP to come in, you can fill out this form. I believe it's like 7,200 or something, where you basically can estimate what your credit should be for the first quarter, and then you fill it out and send it to them, and they give you the money back. Now you got to reconcile it with your first quarter payroll tax returns and make sure that comes out that way. But you can get the money now from them if you want.
That's fantastic.
You don't have to wait.
Michael has, by the way, if you guys have questions, put it in the Q&A. If you're watching this on YouTube, put the questions down below in the Q&A or the comment section. We do check those periodically and do answer them. So Michael asks, if the 2019-2020 income per quarter comparison does apply in my business, will it still apply in a sole proprietorship business case? Thank you. Interesting. So,
yes. Yep, it works for that too. As long as you have employees, that's the big thing.
So here's kind of the point. I mean, I loved the A-Team when I was a kid. This is not easy stuff, guys. This is esoteric, out there stuff that is time sensitive. You need to get your A-Team together. So get your CPA, your lawyer, your financial advisor, your insurance person, whatever it is, your real estate professional. You need to get all these people, whatever members of your team would make up your A-Team. You really do need to get these people assembled and getting to work on your situation sooner rather than later, because something I saw with the passage of Prop 19, it melted down most law firms. Okay. Most law firms were so busy handling matters for their clients. I think the same thing is going to happen, because Janet Yellen said in a couple months ago, or a month or so ago, in the Wall Street Journal, she was quoted as saying, expect a spending bill in the spring and a tax bill in the fall. And once that tax bill is introduced on the floor of the House of Representatives, that is the first operative date. That's the first date it can take effect. Although, Chris, I agree with you. I think a lot of this will be effective January 1 of 2022. But something to be mindful of is it takes time to do a lot of this planning, and there just may not be available resources to get it done. So get your team together, assemble them now. Okay, Rainer asks, does this apply to payroll taxes also, which may be important to 501c3s? So would this apply to payroll tax for a 501c3, Chris?
It does, yeah. Nonprofits qualify for this too.
Yeah. So is this a payroll tax credit, or what credit?
It is basically a payroll tax. It gets administered on your payroll taxes. I mean, a lot of people are going to get credits back, where they're going to get money back from their 941s. But in 2020, it's all going to be credits back because you've already paid everything in. 2021, it'll go against your payroll taxes due and withholdings, but you probably overpay because the credit's so lucrative. You probably end up with a refund coming back.
This is a little bit of a reprise of what we looked at in December, but now we've got more information. So what we're going to do is we're going to go over Biden's 10 tax plans. Do you think the higher maximum rate on income above 400,000, Chris? What do you think that is, a likely or unlikely? Number one.
That's likely.
I think it's likely as well.
That's
What
very
about,
likely.
what
Yeah.
about the P's limitation here, where the you're limited on your deductions? This is item number 2. What this means is if you're in a 39.6% tax bracket and you take a $1 deduction, that means that you only get a 28-cent reduction in your taxes, not a 39.6-cent reduction.
Yeah, and that one's going to affect charitable donations. People that like to donate quite a bit each year, that one's going to be a big impact on that group of people. I do think that one has a good chance of getting through as well. That one probably will be part of any new tax bill that gets done.
Charles Tang asks, does the employee retention tax credit apply to a 501c4? Is that the political one? I think it applies to everybody, doesn't it?
I think so. There's a couple out there. Yeah, it does, because even, country clubs are getting it. I mean, even country clubs are getting retention credits. So they couldn't get PPP loans, but they're getting retention credits.
Okay. Hiking the capital gains tax. I don't know. Do you think this is going to happen, Chris?
This one I think is 50-50, maybe less than that. I don't know. Capital gains is kind of a tricky one. And I don't think, I think that the big money people out there behind some of these guys aren't going to like this, and they will push on this to make sure that this doesn't happen. I think also people will make a case that the stock market will not do well with this going on. So I think that this one is less likely than the first two, but it could happen, because again, like you said, they got to raise money from somebody to pay for all this stuff, or at least start to pay for some of it.
Guys, this is really important because many of our clients, Chris, your clients and my clients, many of our clients have businesses and they have a liquidation event. And what a liquidation event means is that you sell your business. And many people end up paying a lot of capital gains tax. So you might think, oh, well, if somebody has a lot of capital gain because they made a bunch of money on stock, okay, they pay the money. But when you sell a business, a lot of times you don't get the money, for one, right? You're getting some type of note, or you're getting some other type of deal. It's not a necessarily clean transaction where you're getting a big check at one point. So I think it's really important to pay attention to capital gains taxes, just to know, and this is part of we don't want any surprises for our clients. I know, Chris, that's something I don't like. I don't like a tax surprise. If I know I got to pay a certain amount of tax, at least I know, and I can get my head around it. But I really don't like it when clients are surprised.
Everything I've read on this capital gains hike, though, Jim, talks about $1 million of income too. It's not going to be on everyone. It's going to be, if they did it, it would be like, if you make more than $1 million, you got to pay the higher rate on this. But I think they've come up with more of a middle ground on this one and say that, well, instead of it being 20%, it's 28, not 39, something like that. I think that's more likely them doing something like that. Whereas it go to double, basically, is what you're showing there.
Yeah. And Linda asks, is this capital gains for 2021 or 2022 for California? This is Biden's proposed tax plan. So he said, yeah, let's raise capital gains on capital gain over $1 million, okay, to 39.6% from the current 20%. Something Linda and everyone else to remember is California does not have a capital gains tax. They treat it all as income. And any word on the 16.3% proposal to increase the state income tax, I think that's kind of gone nowhere.
Yeah, nothing's gone on it. I remember when this first came out, Newsom was not backing that, and at the time anyway. So it could come down the road again. I'm sure they'll bring it up again, but right now I don't see that as being a possibility. But again, I'm not saying it will never happen, because I think it potentially could happen, or they'll find other ways to raise taxes here because they're going to have to, because the next time we have a recession, we'll probably see some trouble with the state, their own budget.
So higher Social Security taxes. What is this? So what I'm seeing is up to $137,700 for 2020. You pay 12.4% Social Security tax, and that's it. And you pay Medicare on top of that. But what they're talking about here, Chris, is what happens when you hit 400,000 in comp. What happens?
Yeah, then it comes back again. So you got this little gap between 137.7 and 400, where you only pay the Medicare portion, which is 1.45 to the employee and 1.45 to the employer. If you're self-employed, it's 2.9 because you pay both sides. But what they're talking about here is once you go up over 400, then the 12.4 clicks back in again, and you got to pay on 15.3 on everything. So if let's say you had a W-2 of $2 million, under the current law, you'd only pay the higher, the 12.4. So, well, you pay, the 12.4 is split between the employer and the employee. You're going to pay that on just the first 137. Now you're going to pay it on the whole 2 million, other than that little gap between 137 and 400. It's going to make it S corporations a lot more attractive than they already are.
Yeah, we're going to talk about
business
that.
owners.
Yeah, we're going to talk about that in a couple of slides. So if you're a business owner, just stay tuned on that one. Elimination of step up in basis for inherited assets. You know, we had this for a brief period of time in 2010. I think idea because it's very complicated to administer and deal with. Basically, here's what the rule is. If I buy something for $1 and it goes up to $10 and it's in my name and I die, okay, my kids can sell that thing for $10 and not pay capital gains tax. You can add as many zeros as you want. What Biden is proposing is that when I die, all gains are realized, right? So now you would pay capital gains tax on the difference between $1 and $10, or the basis transfers, that $1 tax basis transfers to the beneficiaries. Now, all that means is that it's not forced realization of gain. We're going to talk about that in a little bit. I think that's probably unlikely, a forced realization of gain, but it's possible out there. It's a possible tax plan. Do you want to talk about a 1031 exchange? We've got a couple of videos on our YouTube page that take a deep dive into Section 1031 exchanges. Basically, if I have a rental property and I get tired of the leaky faucets and the broken toilets, and I want to sell that property and buy another one, I can sell the property here and do what is called a tax deferred exchange on another property. So I can sell one property and delay payment of capital gains tax. Chris, how often do you see clients doing 1031 exchanges? Is this something that
all the time? Yeah, it's very common. I mean, and especially in a market like this, I mean, we will probably talk about it 2-3 times a week.
Mm-hmm. Yeah.
Yeah. But I don't think this is going to happen. I think this will be unlikely, especially, and also the basis thing, that's going to be a little challenging too, because the real estate community their lobby's pretty strong, and I have a feeling will be pushing hard against both of these things. But we'll see. I mean, it's certainly an area they connect these things kind of as how they're going to pay to get rid of some student loan debt, is the way I've read some of this stuff, is the money they generate from this is what they'd use to write off some student loans that are out there.
Interesting. And then increased child and dependent care credits. That's good. I guess if you're poor, you're going to get more money. If you have dependents, it's basically free money. So that's a good thing. What about this tax credit for first-time home buyers? Do you think that's going to happen?
I think the real estate community will push hard to get that to happen because it's good for them. I mean, I think that has a good shot to make it. I mean, they've always tried stuff like this before and it's gone through, but they always do it for a limited amount of time, not for, hey, let's put this out there for good. They've done some things when the housing markets needed a little help. They've done some stuff. This is more to help people that are being priced out because the markets are going up so fast, I think, more than anything. But I think this one would have a good shot of making it through.
Good. I mean, I think that'll help out a lot of people to help build intergenerational wealth. I mean, that's the way a lot of our clients, Chris, have made it. They started with the first house, right?
Yeah.
They're young, they bought it. So I think this is a really good thing. Green energy. This is a really interesting one because you and I have actually did this last year. There is a tax credit plan where you can buy into solar arrays and solar businesses, and the government's behind that. And so that's just one example of green energy. And with the goal of reducing, I guess we're back in the Paris Climate Accord agreement. The federal government, it looks like, is going to be pushing a lot of tax advantaged benefits to investing in green energy. And that would be solar, I guess, wind. I don't know if thermal energy is in there, but the big one, though, I think for those of you who rely on federal income tax deductions for oil and gas credits, if that changes, Chris, and that's effective 2022, will they grandfather in prior oil and gas investments? Because that carries forward for a few years.
Well, you get most of the time with those investments, the bigger deductions the year you buy into it. So that's most of the time people have already gotten those, year one. I mean, there might be a little bit going forward, but most of the bigger stuff is year one. I think with this stuff here, the fact that they, they were actually, before all this came about, they were starting to phase out the solar credits. Like they were starting, like they were 30%, they were down to 26, and it was supposed to be 22 now, but they've extended the 26% another year, which tells me they're going to probably do some other things to keep this thing going. Because there was a talk a while back that Congress wanted to see the solar industry operate on its own and not be subsidized by them, and having you and I go and get solar because we want to do it for those reasons, to not that because we're getting a 30% credit. But I think this is going to come back because they're going to use this as a way to get everybody going in this direction to do solar and incentivize them. I always think about solar though with these credits is like, how much more do you pay the person putting in the solar, because they know you're getting the 30% credit too. Exactly. So I don't know how much you're really saving on the thing at the end of the day, but I think it's going to probably be, when they put some new things in there, there'll be some things that are going to be real attractive to do solar, wind, thermal, all that stuff. And there might even be some stuff coming back for cars that have kind of vanished. A lot of times now you buy Teslas and things like that, you don't get any credit for them because the credits have all been expired, but maybe those come back when some of this too.
It's kind of, I had to take a chuckle because Congress says, oh, we want the solar industry to stand on its own 2 feet. Well, what about the oil and gas industry? I mean, they get incredible subsidies.
They do. Yeah.
Anyway.
But yeah, so it's interesting. But I do think where we're going with it, I mean, obviously California wants us all driving electric cars by 2034 or something. So, I mean, I would think that and some other places are starting to talk about this now, that I think that you're going to see a lot more potential incentives to do more of this solar or green energy type stuff.
This is Kay asks, are there any advantages to using an attorney CPA team locally, or is it better to go with medium-sized firms like yours? Kay, I think you need to get the appropriate professional, whether they're near you or whether they work remotely. Chris, I know you're in you have an office in Kauai in Hawaii, and you're in your Hawaiian office now. I live in Sacramento. We have clients all over the state of California. We have clients in other states. But we're spread out, but I think it's important to have a team. And it's whether you use your existing advisors, as long as they have a competency in this area, I think it's fine. But if you feel like, if you talk to your advisor and they say, this really isn't, my core competency, you should probably talk with another professional. We're happy to either work with those professionals or, accept a referral of the client. And this is not like we're trying to poach clients from their professionals, but really we're just trying to help our clients. So, and I know, Chris, you've worked with other CPA firms and other law firms, and I've worked with other, likewise, other CPA firms and law firms helping clients. So,
well, when somebody comes to me, Jim, and asks me about, hey, can you guys do our work, or I want to talk to you about it? Yeah. I always ask them, I said, where you are now, did they ask you a lot of questions, first of all, find out more about what you're doing regularly? And also, are they the ones pushing the planning? Like, are you doing regular planning? Because if you are, chances are you're probably getting good service, and we don't need to step into that situation. But if you're not, and you're just preparing the returns and there's very little interaction other than filling out the boxes, then probably not the best. And so probably there is a need to take a look at maybe improving that situation. That's always what I tell everyone that comes to us new is, and you're getting planning, you're probably doing okay with where you are.
It's really important. The stuff we're talking about here, many of the planning has to happen not after the tax year's over, but many times at the beginning of the tax year. So I'm personally already doing tax planning for the whole year, and we're in February. Okay. Yeah. I'm thinking about it for the whole year. So it's very important that you have a much broader time horizon. Okay. So the big one, I think, is a repeal of the Tax Cuts and Jobs. Is this Turgica? No, this is the Tax Cuts and Jobs Act. This put in a flat 21% corporate tax. I think Biden wants to take that back up to 28%. And this is another one, a minimum tax on corporations with at least $100 million in annual income. And what's happening is the nature of the structure of our legal system is that if the executive team of a corporation does not do everything to minimize tax at every turn, what I mean by that is setting up an entity in Ireland that holds the intellectual property and paying a royalty to the Irish company, which then sucks off all of the income from the American corporation, okay, and pays it at a 9% rate in Ireland. If the executive team does not do that, the board of the company will be sued by the shareholders, and they'll vote in new board members who will put in an executive team who will do just that. So I think this is probably a good law, because the nature of our system is that the board has to maximize value for shareholders. That's their directive. And, if a company's making $100 million a year and they're not paying any tax, Chris, I don't know. I'm a taxpayer. You're an American. I'm an American. I kind of have a problem with that. And this is not a political discussion, but I think this is what this is addressing. Is I think there are people in Congress who say, hey, this is wrong. They got to pay something. It's like an AMT.
Well, I think the thing is you have to realize that these companies, like a corporation is not a person. They're just everybody, you and I, everyone else that has 401ks or investments own these companies individually. They're not people, the corporation themselves. So they don't really pay the tax. We're paying it, whoever the owners are. And so most of the time when you hear that a company's not paying any tax and they made all this money and everything, it's because there's R&D credits and things like that. They have a tax, but it's being offset by R&D work that they're doing, which is very valuable work. You think about it in the pharmacy industry, the pharmaceutical industry, having that out there is just encouraging these guys to come up with bigger and better things. Now, obviously you can argue all day long how they charge for that stuff, but the thing is that we want to encourage a lot of R&D activities, and the government does that with these credits, and these credits offset these taxes. And that's why you get companies like Apple or some of these other companies that have this big profit and they pay very little or no tax, because it's not like they're getting away with anything. They're just following what's out there in the tax code. And the R&D, in my opinion, is one of the bigger ones that they take advantage of, rightfully so, to do that. And the question is, do you get rid of that or you limit that? But then does that limit the company's ability or incentive to go forward and continue to do this type of work than it does our stuff costs more? Because when a corporation has to pay a tax on 100 million, guess what? They're looking at the cost of an iPad and saying, I'm going to charge more for that thing now.
Right.
So at the end of the day, we're going to pay one way or the other, because if they're going to pay, 100 million, they're going to pay 15 million on that. Guess what? The cost of whatever they're selling is going to go up, because that's right on their bottom line, and they're against their bottom line, and they're looking at going, well, I'm going to have to raise the price.
It's interesting too when they say, oh, these corporations are not paying any tax. When you use the example of spiriting away your profits to Ireland, I wonder how much payroll tax Apple pays.
Yeah, that's it. And property taxes too.
Right. And I wonder when people exercise options through grants and other type of stock option strategies, how much tax is being paid. So when they say corporations aren't paying tax, here, let me translate this. When a politician says these corporations aren't paying any tax, what they're saying is they're not paying any income tax. Okay.
Right.
They're paying plenty of other taxes. Okay. Now, so there are three classes of client that Chris and I have. You're either an employee and you get a W-2 and you put that on a 1040, or you own a business and you have a 1040, 1065, 1120. So that's a partnership or corporate return, or you're retired. And I put 1040 and 1099-R because that's the distribution you get from your retirement account, right? Your IRA. So W-2 earners, I would say that these are the hardest people to do planning for, Chris. I don't know if you agree with that, but
yeah, there's not much we can do anymore, because they're taking away business deductions. When you're an employee, you can't write off any of that. For the federal, the state you still can, but it's a much smaller amount. But there's not a lot to do there other than, just making sure that if you get an option to maximize a 401k or do something like that, or you're doing college planning with your kids, if you're able to write off the tuition credit or work that out, there's not as many things there as there used to be when I started doing this eons ago.
But there are some.
There's some, but they're not as many as there used to be.
Right.
It's very difficult.
Small variety. So Agnes asks, how about the elimination of the cap on state and local tax deduction? That one I'm seeing a little back and forth on. So the SALT cap of $10,000 a year, if they throw out the Tax Cuts and Jobs Act, does the SALT cap go away?
Yeah, it would. That would go away. And also, I think when they're looking at the cap and their itemized deductions at 28%, it also takes away the SALT cap. So it means it kind of like puts it under a new cap. So we could be still looking at a cap, but a different type of cap.
Okay, so minimum wage increase. That looks like it went nowhere federally. We do have a minimum wage in California. Something to remember, business owners, is when you have an exempt employee, a manager, right? Somebody who is not paid by the hour, you have to pay them 2x minimum wage, right? That's $30 an hour. So that means you have to pay your manager $60,000 a year. So if you're managing a beauty supply store, you can't pay your manager $45,000 a year on a salary. So you really need to pay attention to this. And is this something, Chris, that is typically going to come up with the CPA, or is this more of like a labor law attorney?
More labor law attorney.
Yeah.
You got to have one in this state. Is you got to have because we anything we do with employees is always we consult with our labor law attorney, and it's just, in my opinion, you got to have one at least available at your disposal whenever you have employee issues come up, especially with COVID and everything else going on and all the things that we have to do now to make sure we're compliant with that. That even adds another level to the whole thing. So definitely a good labor law attorney, also good HR too, somebody that can handle that in conjunction with the labor law attorney for anything to do with employees.
And that's part of the team, that the A team, the reason I put the A team picture up there is your team is going to look different. It's going to be your advisors, and it just depends on what's going on in your particular, in your business or your personal life, but you do need to get your team together and they need to talk. And I always say that if your advisors don't have their cell phones, those cell phone numbers, they're not close enough, right? So when I work with other advisors, I immediately get the cell phone number because we're texting, we're calling, and we just need to cut through because it takes, I know, Chris, if someone was to call you, they'd have to go through layers of people. If they call my firm, they have to go through layers of people. There's no direct in dial, and it's nice. You and I text each other on client matters. And I would say that's the level of cooperation that you need with your advisors. So here is why a business owner might consider an S Corp, an S corporation. So this is a corporation, subchapter S of the Internal Revenue Code that covers these types. So this is not a C corporation where the tax is paid on the corporate level. All the tax is paid by the shareholder. So if you're an owner of a business and you make $650,000 a year, you have a Medicare tax bill of $18,850. If you give yourself a salary of $150,000 a year and take $500,000 as dividends, you save $14,500 a year. Pretty simple.
And there's even more to that too, because you also get the Section 199A deduction, which is 20% off the top as profits. So you take the profit, take 20% off the top for federal purposes, and that's not taxed at all right now under the 2018 Tax Act, which they're trying to maybe get rid of that as well. But right now it's in place, and that's been a huge benefit to a lot of small and medium-sized businesses.
So if you've heard your advisors, your accountant or your CPA or your lawyer or, business manager or whatever say, hey, you really should think about an S Corp for your business. This is why. This is it. This is the reason why. Okay. Very important. Also a little bit of asset protection too, which is always good. So you're limiting the liability to the corporation. Now, if you're retired, don't ignore tax planning, folks. If you have RMDs from IRAs, that's the biggest tax disaster that we see. Many of our clients will have IRAs of $1, $2, $3, $4 million. And then when they hit now age 72, you have to take out about 4%. Well, 4% of $1 million is 40,000. 4% of 5 million is 200,000. That just gets added to your income. All right. So a lot of this ends up going out as income tax. So it's something to be mindful of. There are things that you can do to plan for this. Sometimes they take years. And if you're already in your RMD stage, there's still stuff we can do. But the thing is, I would say that, Chris, our wealthiest people have three things going for them. Number one, our wealthiest clients. Number one, they hire the best advisors. Number two, they listen to their advisor, right? They take action. Number three, they have assets, they have capital, and they can deploy that in certain ways, in tax advantaged ways. If somebody says, I made $1 million, Chris, it's April 14th. I made $1 million last year. I don't have any money. I spent it all. And I don't know how I'm going to pay my taxes. There's not a whole lot of planning you can do for that person, right? But if they come in the prior year and they have other assets, there's a lot of stuff that we can do for those clients. Yes, sorry, Charles. He says, I've been trying to schedule an appointment with your firm, but you seem to be busy with Prop 19. Call back. Our Prop 19 matters. We're finishing up the last ones today. and putting that to rest. Does an S corp make sense for someone whose income mostly comes from W-2, but also has some independent consultant income as a contractor for a 501c3? I think that, and that's from Anonymous, Chris. What would you say the break even is on this?
I think you have to be ongoing. It's not just a 1 year thing and out, like deal. And I would say you want to be up over 100 at least, excuse me, to make it worthwhile. I mean, otherwise, I don't know if it's as beneficial to do.
Okay.
Somewhere in that range.
So
100, 150.
We've talked about a lot of these tax rates. So income tax going up to 39.6, gift tax increase from 40 to 45, potential elimination of step up in basis, potential higher capital gains taxes, and then the death tax rate going to 45%. And so here is the Tax Foundation released a slide. And when I looked at this, I suddenly realized if there's a tax party and the federal government is putting on this party and collecting taxes, California always shows up. They're like, hey, if the federal government's taxing, we're going to show up because we want ours too. And here's how you can get to an 80% death tax. So this is from the Tax Foundation, which is kind of a right-leaning organization, a conservative organization. If you take $100 million estate, now you might go, $100 million, that doesn't apply to me. It's just so the numbers are easy. So that first line value of the original asset is $100 million, the estate. The capital gains are taxed at 39.6% plus 3.8%. That's over 43%. This is assuming that this asset has a zero basis, okay? Which is kind of out there, but I'm just giving you the worst case scenario. But I'll tell you what, if the federal government, Chris, if the federal government's taxing something for capital gain, do you think California's going to jump on that? I mean,
for sure. They will definitely jump on it. No
doubt. So these numbers actually get lower. And then what you do is the $3.5 million, where pretty much all the professionals are collectively anticipating a $3.5 million Biden exemption. That's a death tax exemption. You get to keep that. And then the balance is taxed again at 45%. Now you may say, Jim, this is crazy. How can the government tax property twice? It happens all the time. Okay. So if you take money out of an IRA, if you inherit an IRA and you pull that money out, you're going to get taxed. You're going to pay death tax. You're going to pay income tax. The money will get taxed twice. So 67 plus 13 is over 80. That's how I got to 80%. Will this happen? I don't know. But I'll tell you what, if you own a business, if you have any kind of family wealth, you really do need to pay attention to this. Okay. Don't just, ignore it. I mean,
Jim, the ones that have the bigger IRAs, what's I think you're going to see happen more and more is, especially with the limit on itemized deductions, is trying to give some of the IRA to your favorite charity or church or whatever directly, and that way you don't show it on your return, and then you don't show it as a deduction, but you end up getting a better deal out of the whole thing because you're not showing the income, and then the deduction's limited, so you get the whole thing by doing it that way. So I think they're going to see more of that going on when this stuff, I mean, it already should be going on now. If people are real charitable in nature and want to give away and start peeling down their IRAs, because those things are the most expensive things to hold upon death, really, at the end of the day.
Yeah, we've got a webinar on charitable giving where we cover how to make your RMDs, instead of it going to your own bank account, you have your required minimum distribution go to your charity directly. Yeah. And that's a very powerful tool because it doesn't show up on your taxable income and throw off your Medicare Part B. And there's a lot of other, it's kind of like pulling at a thread on a sweater once you're a Medicare recipient and a Social Security recipient. Anonymous asks, if I sell crypto in 2021, if I sell crypto in 2021, what is the long-term capital gains tax rate for earnings over $1 million?
Well, right now it's still 20% plus the 3.8 for the ACA tax, the net investment tax added on, and then California would be probably 12% to them if your gains over $1 million. But so nothing's changed. It's under today's law, it'd be 23.8% to the federal and probably 12%, somewhere in that range to the state. But if some of the things we're talking about happen, I think these things would be more 2022 if they change the tax the capital gains rate. It would be more on the federal side, not California, but it would be could be significant difference.
Michael points out there's a 1.5% California tax on S corp profit. Yes, and so that's part of the calculation. Should you do an S corp? Should you not? But that's on taxable profit. Are they going to not require an RMD in 2021 as in 2020? Have you seen anything on that, Chris?
I haven't seen anything on that. I got to look that up and see if I thought I saw somebody saying that they weren't going to have one in 2021, but I haven't seen that yet. Somebody told me that the other day. They thought 2021 was going to be exempt too, but I haven't seen anything on that yet. I got to look a little closer now. One other thing that I wanted to bring up just regarding California just made me think of this is that, believe it or not, California may exclude PPP loans from being taxable. I never thought this was possible, but they're talking about it. So the first one and the second one. So it's not done, but they're at least engaging in that they might allow it and conform to the federal law, meaning that right now we don't have to pay tax on the first PPP loan or the second one if you're a business owner and you got one of these, which is going to be huge for a lot of people on the federal side, meaning that you can write off the expenses you use the money for, and you don't have to show the money coming in as income. California is looking to do it the same way, maybe. So
I love it. Well, when are they going to tell us? We got to file our tax return.
Yeah, well, that's what I was getting at. Is if you're in that boat, don't file yet, because we got to wait it out a little bit to see if they're going to do it. Because you don't want to go back and file an amended return. So you plan that they are still. That's what we've done with our clients, that they are still taxing it, and plan accordingly with your taxes. But you might even have to wait it out past an extension. But make sure you pay in enough that they are going to tax it. And if they don't tax it, it's like a pleasant surprise for us all. And because I gave it like almost zero chance 2 months ago, but I'm moving that up now based on what I'm reading. It doesn't mean it's happened or going to happen, but it's definitely the fact that they're talking about it is incredible to me.
Rayner asks, do you anticipate reductions in tax benefits for donating real estate or easements to land trusts and other eligible recipients?
I haven't seen anything specifically on that. I think that, you could see what happens is if they do limit your itemized deductions on stuff like that on your overall income, that's where you'd see the reduction at. So you wouldn't be able to get the full benefit. But most of the time with charity, you get to carry that forward. But it'll be interesting to see how they write that up. But, that if they do follow through and only allow us all to write off 28% in total of our itemized deductions, if you give a big donation deduction of appreciated property, or you give away something of appreciated property, you get a big donation deduction, you could see a limit there. And that's where that could be a problem. But we don't know yet because it's too far off to, the Congress has got to go. When Trump proposed a lot of his stuff after he won in 2016, when they finally got done with the bill, it was a lot different in a lot of areas. He got the 21% through, but everything else was very different. There's a lot of things he didn't get either. And so, and a lot of things that were changed. And so I have a feeling that'll happen here too, but it'll be interesting to see. It's a tough one because, if you want to do this, you might as well do it now when you know what it is today. Right. If you're going to do that.
Anita asks, my understanding is the current death tax exemption of $11.7 million is in effect until 2025 or 2026. Yes, it's effective until December 31, 2025, current law. Do we assume that if the exemption is lowered to $3.5 million, would it be implemented before the 2025? Before 2025? Yes, I would anticipate that being implemented either effective the date the bill is introduced on the House floor. And Janet Yellen said, expect a spending bill in the spring and a tax bill in the fall. The first day of fall is September 21st. And something that I've learned being on this earth for 51 years and being a student of history, take leaders at their word, okay? Don't think that, they're gonna say one thing and do another. I think we have to take things at face value. If the Treasury Secretary says, expect a spending bill in the spring and a tax bill in the fall, that's what I'm expecting. This is not difficult as much as you don't want to have it happen. You just need to be ready for it. And we're going to cover the ins and outs of that a little bit. And it's also on we have a blog post. I did mention that link to our website on the Biden tax hike. There is something called gifts made within contemplation of death. And this is very important. If you make a gift within 3 years of death, that gift comes back into your estate. The effective date Even if there's no change in the death tax, people, December 31 of 2025 is the last day of this expanded exemption. January 1 of 2026, we end up with a $6 million exemption. That's under current law. So if you go back 3 years, you have to get all your planning done by December 31 of 2022, right? Because if you make a gift in 2023 or later and then pass away early in 2026, that gift comes back into your estate. So this is very important. We're stepping up the planning because 2022 might be too late. You might need to do this in 2021, anticipating a change in this the tax exemption to $3.5 million per person, right? So again, go to our YouTube page, subscribe to our YouTube page. If you're watching this on YouTube, please go to our YouTube page and subscribe. We are putting out a lot of content, and it will pop up in your feed. Again, as we said, it's likely effective 2022, but can be effective when it is it's presented to the floor of the Congress at the House of Representatives. That's where the bill would originate. Many of the tax changes involve, and if you want to talk about this, Chris, why you think it's not going to be 2021? I mean, if they pass a tax hike in November that changes payroll taxes, and they say, oh, well, you got to have payroll taxes above 400,000. What if someone's already made 400,000?
Yeah, it'd be a mess.
Yeah.
It'd be a complete mess, and I don't think they can do it. I think there's a few things like the estate tax exemption amount could be changed, the date that they introduced the bill, that could easily be done. But any of this stuff that has to do with these things here, maybe the capital gains could be done based on when the gain happened. So if you had a gain early this year, you'd be under one rate if it's under later in the year. But typically they don't do a lot of things like this retroactively. It's not like it's never been done, but it's not often that it's done. And I have a feeling they'll start at 1/1. Like when they passed the bill when Trump became president in 2017, it took till the end of 2017 to get it done. And everything was pushed to 2018, really. There was a couple things that had a December 17th date, like the difference between what you could write off for mortgage interest from $1 million to $750. It went down to, like, if you got the loan somewhere between after December 17th of 17, it didn't go to 1/1/18. But it's going to be very rare. None of the bigger ones like the payroll taxes or the income tax, I think they're going to stay the same for 2021. Same with the Section 199A deduction as well. I think it was too messy to do it in the middle of the year.
Oh yeah, I mean, and so what are some people who should do what and when? And and we have Susan has a question. If we give away $2 million now, after 2025, will we only have $1.5 million left in the estate exemption? So if we want to give away more than $3.5 million, that needs to be done before 2022. Yeah, I mean, so here's something you need to understand. The Treasury has already come back, has already announced there is no clawback. So if I have a $10 million estate and I give away $5 million, and then I die having $5 million, but I can only leave $3.5 million tax-free, I have no more exemption. It's gone. The whole $5 million subject to tax. They're not going to claw back the prior $5 million gift. They're not going to do that. But I have no exemption. So let me say this another way, is if you make a gift now of more than $3.5 million, and if you die, there's a $3.5 million exemption, there's no more exemption left. Everything's going to be taxable. So for the clients who have 10, 20 million in wealth, whether they're single or married, they really should be considering some gifting strategies that are out there that frankly have been the purview of very wealthy people for the last 10 years. But now I would say the mass affluent needs to be looking at some of these strategies. So I would say that because Chris, you and I are on these webinars, they're for industry people. You need to start this planning now. This is not something where you can wait. We're still getting calls on Prop 19. Prop 19 is effective next week. We're still getting calls. People are like, I need to get this done. It's like, sorry, we're just not taking any more business. I would anticipate the same thing happening in the fall. And this is I'm telling you this from my heart, because what I saw with Prop 19 is it melted law firms down, right? They couldn't even get their work done. So many of their clients were calling them. And I think the same thing's going to happen as this sort of drumbeat of the tax increase happens. You need to get your team in place now. So if you have more than 2 million in net worth, I think you need to start looking at gifting strategies. I think that's the cutoff, because 2 million will be 4 million. million exemption that's putting you into the tax realm. So again, subscribe to our YouTube page. If you have not done that already, go ahead and do that. And this is how you contact Chris. Go to his webpage. It's muncpas.com. Not really hard to, Chris Mann CPA, and click the contact button. And then that's how you can reach out to Chris. Agnes asks, the $3.5 million exemption is per person. So is it $7 million for a married couple? That's the logic. Okay. If you've already lost a spouse, by the way, Chris, I don't know if you want to talk about this. If someone's lost a spouse within the last 2 years, what should they be filing?
If they don't have any kids, dependents still, they're filing as a single person.
But what they should do is consider filing a portability return to pick up
that's right.
your deceased spouse's
portability.
Right, because that's 10, 11 million bucks. That's extra on top of the $3.5 million. So
that's a given to do that. Yeah, you definitely want to do that if you have assets, because it does take that already out of the mix.
Well, I'll tell you what, too. I talk to a lot of lawyers and I ask them straight up, do you guys do portability? Here's what I'm talking about. When somebody dies, you can file something called a Form 706, which is a federal estate tax return. You can think of it as federal death tax return. People file those even though no tax is paid. Why? Because the spouses can now inherit called the basic exclusion amount, which is this $11.7 million for this year. So if you've lost a spouse and the filing time is generally 2 years, sometimes it's longer, but if you've lost a spouse, you really need to consider filing for portability to pick up the extra exemption, because we may end up with a $3.5 million exemption. Chris, we can end up with $1 million exemption. I don't know. We're going through this change. And Chris, you and I have talked about this. So many of our clients, the best year they had in business was 2020. And for so many people, the worst year they had in business was 2020. It's been a massive redistribution of wealth. I mean, I think of our clients who are restaurant owners and maybe they own gyms and whatever it is, that those people are pretty much wiped out. I mean,
well, if you just decide if it's a fit and we can do something, and everybody's situation is so different. There's going to be some people that this Biden changes won't affect them at all. And there'll be others that will be helpful and be a good resource for you. That's not worth making any kind of change.
Yeah. And I will say, for those of you who have your A team already assembled, reach out to them now. Like, start this now. Don't wait, because this stuff is moving very fast. And there are a lot of time limitations on here that if you look, you don't know what you don't know. So reach out to your experts. If you need some help in that area, you can reach out to us. Please reach out to us. But again, if you've got your team together, go back to that team and work with them. So we'll open it up for any further questions. If you guys have any, if you're watching this on YouTube, go ahead and put the questions in the bottom, and we do watch that periodically and do address your questions. But Chris, I want to thank you so much for coming here today. These are always very popular. We have tons and tons of people on the webinar here today.
Oh, you froze.
I think we have any other questions? And it looks like we'll just call it. So thank you very much, Chris. Enjoy your time.
Thank you, Jim. Appreciate it.
In Hawaii, where it's not crowded. That's good. You actually do have an office in Hawaii. It's legitimate. It's not, you're not in your office in Hawaii. You did acquire practice. Okay. All right.
All right. Take care, everyone.
All right. Thanks.
Thanks for your time.